If you've ever Googled how to finance a rental without W-2 income, you've probably heard of a DSCR loan. They're everywhere right now, and for good reason. They let you qualify for an investment property without showing your personal income, but they're not for everyone. In this video, I'll walk you through exactly how DSCR loans work, when to use one, and when to run the other way. Quick reminder, if you want weekly insights on smart mortgage strategies, hit that subscribe button so you don't miss the next video. Let's talk about what a DSCR loan is and why it's different. DSCR stands for Debt Service Coverage Ratio, and it's a financing method that looks at how well a property's income covers its expenses. Here's the key difference. Unlike conventional loans that require W-2s, tax returns, and personal income verification, DSCR loans focus entirely on the property itself. Lenders will look at the gross monthly rent, either from a lease or market rent appraisal. They'll look at the monthly mortgage payment, including principal, interest, taxes, insurance, and HOA or assessment fees if applicable. And from there, they calculate the DSCR ratio, which is the gross rent divided by the principal, interest, tax, insurance, and assessments. So gross rent divided by property expenses equals the DSCR ratio. Now, most lenders want this ratio to be at least 1.0. meaning the property earns enough to cover its costs. Other lenders or programs may require a 1.2 DSCR ratio or higher for safety margin. And understanding this ratio is critical because it's your make or break number for getting approved. So why are DSCR loans so popular among investors? Well, here's the top reasons that I see investors using these loans. No personal income requirement. This is perfect for full-time investors, retirees, or self-employed borrowers that have issues documenting their income. Fast approvals. Lenders focus on the property's cash flow, not your taxes, so there's less paperwork during the underwriting process. That means less things that can go wrong. Scalable. DSCR loans are scalable. Unlike conventional, they make it easy to grow a portfolio without hitting property limits. For example, Fannie Mae, Freddie Mac generally cap out at 10 properties, 10 mortgages. If you want to go beyond that, DSCR is the answer. Short-term rental flexibility. Lenders sometimes allow these loans to use the Airbnb, VRBO, or short-term rental income to qualify the property. This can be substantially more than a long-term or mid-term rental, so there's a big advantage to using the short-term rental calculation. LLC friendly. Many DSCR loans allow you to buy under a business entity, which can protect your personal assets. If you're focused on scaling quickly or maintaining financial privacy, this type of loan will check all the boxes. But let's also discuss where DSCR loans can backfire. Like any financing tool, DSCR loans come with their own drawbacks and downsides. So here's what to watch out for. Higher interest rates. You can expect the interest rates on a DSCR loan can be anywhere from 0.5 to 1 point higher than a conventional investment loan. Larger down payments. You'll likely need at least 20 to 30% down, which can tie up a lot of capital. Stricter cash flow standards. Properties with weak cash flow may have problems qualifying. Prepayment penalties. This is a big one. Most DSCR loans can lock you into a 3 to 5 year prepayment penalty, so it's important you discuss this with your lender so you know how much your penalty is, how long it'll last, and what options you have to buy it out. Limited lender options. A lot of lenders don't even offer or know about DSCR loans, and some cap how many you can hold. So make sure you're dealing with a knowledgeable mortgage broker that has access to a lot of different institutions, a lot of different programs in this DSCR realm. These factors can make DSCR loans less flexible and more expensive than traditional options, so you need to weigh the costs carefully. So when do DSCR loans actually make sense? Well, let's talk about a few scenarios where they shine. You've got experience and you've got cash reserves. These loans are great for investors who can handle unexpected challenges. The property cash flows conservatively. As long as the income of the property covers the expenses, even with a little cushion, you're in a good place to get a DSCR loan. If you're buying or want to buy in an LLC, DSCR loans are one of the easiest ways to finance under a business entity. You're trying to scale your real estate portfolio. If you need financing that matches a fast growth pace, DSCR loans can be the perfect tool. Now let's talk about when to proceed with caution on DSCR loans, when to think twice. If you're a first-time investor, if you're brand new to real estate, DSCR loans may not be the best starting point for you. Banking on optimistic rent projections. If your numbers are relying on top dollar Airbnb rates or top occupancy rates, then you need to think twice and make sure you're being more conservative. Tight financial margins. If you can't weather a couple months of vacancy or interest rate increase, it's maybe a financial risk to take on a DSCR loan. Short-term plans. Prepayment penalties are prevalent with these loans, so these penalties can eat into your profits if you plan to sell or refinance within the first year or two that you're in the property. So make sure to discuss that with your lender to get a shorter prepayment penalty that matches your goals. Sometimes the best move is to wait until you're on more solid ground financially or find another financing option. Here's how to evaluate whether a DSCR loan will work for your deal. Calculate realistic rents. Don't just rely on Zillow or Airbnb. Dig deeper and find out the real market rent for the property. Make sure you factor in all the expenses. Include a vacancy factor, maintenance, repairs, and management costs if you plan on using third-party management to manage the property. Get a full term sheet up front. Look at the rate, the fees, the prepayment penalties, and the reserve requirement for the loan that you're applying for. Work with a knowledgeable, experienced mortgage advisor. Make sure that you're partnering with an advisor that understands these DSCR loans and isn't just focused on residential and personal home lending. DSCR loans can be a powerful tool, but they're not a one-size-fits-all solution. The key is knowing exactly what you're signing up for and whether it aligns with your strategy. Now, if you're watching this video because you're trying to navigate today's economy as an investor, check out my last video. Will tariffs tank the market or trigger a rally? It breaks down what's happening in the market and how it could impact your next move. And if you have questions or need help analyzing a deal, reach out. I'm here to help you invest smarter. Take care.